Hey, Saretsky here. Welcome back to the show. Lots to touch on this week. We got some updates from the Vancouver and Toronto housing markets with some of the March data. Some info in there that I think is, again, sort of following along with a lot of the trends that we've been talking about on this show for quite some time. It's going to walk you through that. I want to touch on what's happening with the tariff wars as well. I think there's a message in there that I think a lot of Canadians, in fact, I'd say most Canadians are missing. And that is incredibly important as we look to this massive mortgage renewal wall that Canadians are hitting here in 2025 and into 2026. So what that means for you moving forward, and unpack all that in this week's episode. But we have to start off first and foremost with the Vancouver housing market. That's where I work and on a everyday basis, selling real estate here in Vancouver. You look at the stats for the month of March, Vancouver home sales, the lowest in 25 years outside of March 2019. So other than March of 2019, it was the fewest home sales in 25 years. So an incredibly bad month for sales activity across the greater Vancouver area. What we're seeing is basically active listings or new listings coming to market is well above trend as well. So you've got incredibly weak sales, above trend in new listings. Obviously, that's pushing months of inventory higher. Around 7 months of inventory for sale in the greater Vancouver market. Obviously, that's putting pressure. It's putting pressure on prices, but that is yet to really show up in the official home price index, which is actually flat, yes, zeros on a year-over-year basis. But in reality, what we're seeing on the ground is you've got this really illiquid market, right? So you've got a whole bunch of product that's sitting on the market for, a month, 2 months, 3 months. It's just not selling. And if it doesn't sell, it doesn't show up as a sale price and doesn't show up in the sales price data. So the stuff that actually is transacting today is sort of more the entry-level type of product we're seeing is still moving okay. And you're seeing basically a flight to quality, which is to say that these move-in ready type of houses that don't need a lot of work, they're in really good locations, better buildings. Those are the types that are moving. And then everything else is just sitting and languishing on the market. So an important lesson there for sellers. Of course, I've highlighted this before, but we have to roll the clocks back to the pandemic, right? What happened during the pandemic? Well, people started leaving the cities. They wanted more space. They didn't want to be in the hustle and bustle. They wanted sort of the quieter, remote work from home life in the suburbs. And so what happened was the suburbs prices pushed up the highest, which we call the Fraser Valley. And so Fraser Valley home prices over the last 10 years has been like a rocket ship. The growth has been unbelievable. And that's now where you're seeing the sharpest pullback in home prices, but also the I would argue more home price corrections coming, because what you're seeing there is all the development, not all of the development, but a large cohort of the development over the last 5-6 years has been in the Fraser Valley, places like Langley, Abbotsford, Surrey, where all of the new products have been built. You had a lot of investors flooding into that market. You had a lot of first-time home buyers. And so if you look at Fraser Valley condo inventory, this is the resale market. Resale inventory is at all-time record highs in the suburbs, in the Fraser Valley. So again, keep in mind, when you think about the suburbs in the Fraser Valley, you had record home price appreciation. So, it got so far ahead of itself. You had rampant immigration growth, which, of course, a lot of that goes into those suburban markets, which is now pulling back. And you got a huge spike in mortgage rates over the last couple of years, which, again, you think about the suburbs is a little bit more blue collar. There's not the sort of same depth of buyer pool as you have in places like Vancouver. And so all three of these sort of scenarios are really hitting that market. And again, you've got record high resale inventory in the Fraser Valley, and you still have a record construction pipeline, okay? Record number of units that are being built, that are actively being constructed, that on closing, they will close. And many of these people that were investors, they will try to resell on completion. And that should add to your inventory levels. So the outlook for segments and the sectors of the market, particularly these Fraser Valley suburban type condos, is downright ugly. And that is the same story and picture that we're seeing in the GTA. GTA home sales, the lowest in 30 years, 30-year low in the GTA. Again, think about how much the population has grown. Think about how much the housing stock, I should say, has grown over the last 30 years. So to have a 30-year low in sales activity, inventory up, I think 88, 89% on a year-over-year basis. And again, a record pipeline of new construction condos that will be completing over the next 12 to 18 to 24 months. After that, a lot of that sort of chunk of inventory will complete, and we're not starting new houses today. So that will eventually sow the seeds for your next shortfall, your next housing squeeze, and probably your next upcycle. But that, again, I think is still 4 to 5 years out when you actually start to see the ramifications of not starting new housing today won't really show up in the marketplace for a number of years into the future. So keep that all in mind. Obviously, as we're seeing this play out, the tariff stuff is boiling up. We're starting to see the impacts in the Canadian labor market. We saw in the month of March, the unemployment rate, the number of jobs lost, about 33,000, 62,000 of which were full-time. The unemployment rate ticking up to about 6.7%. Again, almost 120 basis points off the pandemic lows. So probably more pressure there again as some of the tariff stuff filters through. And we got some update on the tariff stuff this week. Stuff that I think is incredibly important for Canadians to pay attention to. Remember, we were hit first and foremost along with Mexico, and we were not hit again on the most recent announcement just this week. So Canada actually came out relatively, I don't want to say unscathed, but less impacted than we probably initially had thought. So that's sort of somewhat of a relief, at least the silver lining for Canada's labor market. But what I think is important to sort of shape out here is obviously not only has the stock market sold off, but bond yields are tumbling, okay? People that in Canada, rightfully so, hate Donald Trump. They got the Trump derangement syndrome. You're focused on the mainstream CBC news, and you just can't look and rationalize any of these policy moves that the Trump administration is making. I would really point you to comments from Secretary Treasury Scott Bessent, who said before the election that he believes there's going to be a new Bretton Woods system, a basically new global monetary order. This is the magnitudes of which you haven't seen since the 1970s. He said that he wanted to be the next Treasury Secretary because he believes that we're going to see the next Bretton Woods. And this is playing out. This is all part of it. Again, you might not agree with the plan. You might think it's chaotic, unorganized. You might think it's going to backfire. And that's all fine and very relevant comments. But what is important here is that it is in fact happening. There's nothing that you and I can do about it. And so what are the ramifications moving forward? So again, I would argue that what we are seeing here, and we actually have had Bessent's comments on this. Remember, this guy is not a formal central banker. He's not a politician. This is a guy that ran a global macro hedge fund for like 30 years, trading alongside Stan Druckenmiller, probably one of the most successful investors of all time. This is a guy that understands the financial markets, the financial plumbing, that is ushering in a new monetary order around the world that is happening right in front of our own very own eyes. And so I want to clip to some comments of Bessent, who gave an interview just this week. Let's clip you. They need to get bond yields down. They don't really care so much about the stock market. The stock market's had a great run. It serves the ultra wealthy. They're trying to get the debt burden lower, not only for households. Again, you could agree with that and disagree with it, but that's what they're telling you. If you look at the US's fiscal position, it was clearly unsustainable. It was not going to work. It was going to end up in a crisis, and it still might end up in a crisis. But if you look at the U.S. fiscal position, there's $9.2 trillion of debt that must be refinanced in 2025. If you rolled it into 10-year bonds, every 1 basis point in rate drop saves approximately $1 billion a year. So a 0.5% drop in the US 10-year would save $500 billion over a decade. Lower yields free up fiscal room. Without them, core spending gets crowded out. So they're telling you they need to get yields down. We saw the US 10-year actually fall below 4% this week. So the plan, again, albeit chaotic, disorganized, right now is to get yields down. So what does this mean for Canadians? Well, again, we've got the mortgage renewal wall in 2025 right now, and in 2026, that relief is coming. Okay, so again, you might not like Trump and everything, but he's actually helping out Canadian mortgage rates today, right here, right now. We're seeing Canada's 5-year bond yield, the day that I'm recording this, dropped another 10 basis points. I think it's down 30, 40 basis points this week alone. A lot of mortgage rates today in Canada, 3-year, 5-year, in many cases are now under 4% and falling. And we're probably going to see more cuts from the banks next week. And so there's certainly an argument for people that are coming up for renewal. This might not be a bad time where you can take 5-year debt and lock it in at 3.99%. In a very uncertain world, in a world where inflation could very well percolate again, maybe sometime later this year, maybe sometime next year. I would argue the tariff stuff is basically, again, engineering a global growth slowdown, probably potentially a recession, bringing yields down, deflationary in the near term, and arguably inflationary in the medium to long term. So again, could be an opportunity now to strongly consider taking some risk off the table and locking in favorable rates. And again, remember about 18 months ago, 5-year mortgage rates in Canada were about 6.5%. Okay, so there's an opportunity today to lock in at 4. That is compelling. Now, again, some people will take the riskier side of the bet and say, well, why don't you continue to ride variable if you are going to enter that global growth slowdown? Could you see a further decline in fixed rates? Go variable and wait, basically attempt to be a bond trader and lock in fixed rates on the lows. Probably easier said than done. Kudos to anyone that is willing to ride that bet. I think people that have been through the variable mortgage process, myself included, in 2021, 2022, I'd say fool me once. I think you're in a very uncertain world where I would be cautious and hesitant to be floating a whole bunch of debt in this sort of chaos that we're living in today. But there you have it. So the outcome of the tariff stuff, again, we'll see how it all plays out. But right now they are telling you what they care about is not the stock market. What they care about is getting bond yields lower. And I think the huge reason of that, again, is to fix the U.S. fiscal position, which was clearly on an unsustainable path. You think about the amount of debt they accumulated during the pandemic era. And so we'll have to watch and see. But again, for Canadians, we have a huge, massive chunk of mortgages that are renewing. This is the opportunity now where you are in this global growth slowdown with yields coming off significantly, becomes an attractive place to fix some of your debt in a very uncertain world. So, as always, hope that helped. Hopefully people can give some pause to reflect and understand what is going on behind just headline scenes here. Again, it is a chaotic mess. It is impacting everybody, even myself. I mean, you think about the housing market, the tariff stuff certainly isn't helping, real estate transactions. Again, I just told you 20 and 30-year lows in places like Vancouver and Toronto. So everybody is being impacted. But we have to understand that this is a changing monetary global order, whether we like it or not. So, as always, we'll see you next week.